So look, I wanted to share that list with you because I think it's hilarious.
It's a long list.
I know, but we're not going to read it all together. But it's just funny. I'm going to pick a couple of my favorites. So this is an article by my man Sam Moreau, 11 ways cynics argue any news is bad news, which is just so true. So he put together an awesome little list here of whatever economic metric you want to measure. And then regardless of the direction, people pick it up and sell negativity and say, this is terrible because.
Oh yeah, we've seen it before where the Fed comes out with some kind of story where you're like, please don't raise, please don't raise, please don't raise. They raise, market goes up, and you're like, why'd it go up? And then at the end of the day, it's like, well, market said that raising is actually good because of this and this and this.
100%. This is let me pick the one that I loved was a Walmart one. Walmart sales. When Walmart sales disappoint, it's a bad sign since they're an economic bellwether and the world's largest retailer. When sales boom, it's a bad sign for the economy because it must reflect financially stretched consumers trading down for higher priced retail options. So perfect.
Yep.
I love that.
You mean you can make a story about anything?
Well, but it has to be negative because pessimism sounds intellectually alluring and like someone's trying to help you out. And the optimists in the room are just Pollyannish idiots that just think the world's all rainbows and butterflies.
We need to get our rainbow colored glasses one of these episodes.
Oh, you got to wear those. And it's rose colored glasses, okay?
Market
volatility. Right. High volatility is bad because it reflects elevated uncertainty and markets hate uncertainty. Low vol is bad because it must reflect complacency in financial markets, leaving them vulnerable to a major sell-off when bad news breaks.
You could probably have Lane's favorite pink tie index on here as well. People are wearing pink ties, it means they're overconfident and market's going to fall. When they're not wearing pink ties, it means they're not confident, market's going to fall.
Yeah, there you go. To the cynics in the room and to the cynics watching, we love you, we need you, so we can keep proving you wrong every single
time. Short the market. Let's do it. Short it.
Welcome to episode 38 of Talk Your Chart. My name is Marco Segrera here with my beloved Brett Horowitz. Today is July 3rd, 2023. Brett, I will kick us off with a couple quick ones. I think you and I talked about this one. I think you mentioned you were going to bring this on once yourself. Retail behavior as it comes to trading stocks. What we're looking at here is the unfortunate fact that retail investors have sold twice as much as what they accumulated during the pandemic over the past 15 months. So it's all good, all rosy, buying up, markets always go up, markets always go up until they don't. And unfortunately, capitulation sets in. And here you see investors doing what everyone knows you're not supposed to do. So it's just a charted course of bad behavior, unfortunately.
This is why Buffett's line, be greedy when others are fearful and fearful when others are greedy, makes perfect sense, because you just got to do the opposite of what the retail investor does. Like my guy Irwin at Pico Italia, whatever he says sell, I'm buying.
Yeah, I know. But that's like one of those things easier said than done, right? But anyways, this is that. Hopefully you're not one of them. If you are, don't lose the lesson, right? And let's also get real. I'm sure some of this here, it is talking about S&P and NASDAQ companies. So it is trying to lean to not like your micro cap stocks. It is the larger companies that you probably shouldn't have been trading in and out of. But I'm sure there's some of that in here where you bought something you had no idea what it was, and maybe you reinvested into something better.
Well, look, maybe there are some people that sold stocks, took profits, are now in bonds paying 5 or 6%, right? Like maybe some of this was some smart selling, rebalancing.
I'm sure there's slightly more thought within a percentage of this, but I think the average tells the story. Last thing, I want to give a little shout out to Ryan Dietrich. He's an economist that I follow on Twitter. He is eternal optimist. I love his stuff. He puts out good charts. This chart, just to make it more digestible, is ultimately saying it's quite specific. After the S&P 500 has 6 down days in a row, that gets you to a new 52-week low. What happens over the next 12 months? Right? So he made this call in September 27th of 2022. So we got to a new all-time low, September 27th of 2022. The final, at least up to now, low was October 12th of 2022. So we had about a month there. just shy of where markets were still falling. But 12 months later, what he said here in this chart, it showed, hey, look, it's not me, it's the data, 20% up on average, 12 months after that event occurs. He got a ton of crap for it, especially leading up to October. But 12 months later, just shy of 12 months later, he's looking pretty correct.
Well, let's see if he can do this consistently, and then in which case I'll put some money on his bets, because everyone can get it call right every once in a while. Let's see if he can do it on the opposite end too. When is he going to call the top so that we know when to get out before it drops?
Yeah, but he's not that guy, right? So all he's saying here is, hey, look, for everyone thinking it's going to get worse and worse and worse, he was taking the whole risk is least present when it's most felt attitude. So he's saying, look, man, we're hitting 52-week lows. If you're not allocating now, then when the hell you're going to allocate? Get beyond a year, and you should be in a meaningfully better position.
I get it, but he could have made that call 2 weeks earlier, a month later. Like any of those would have done the same result.
Absolutely, yeah. But again, the principle holds true. When the crap is hitting the fan, if you extend your time horizon enough, you're usually going to get to a good outcome because markets trend upwards. He's not a market timer. He's the opposite of it, which is why we like Ryan. Thank you, Ryan. Good call.
I'm
Brett,
not
what do you
that
have for us?
impressed. I was surprised by something that seems like people are doing in the last year and a half with inflation spiking. It was asking folks, what are you doing as a result of the fact that prices are so much higher? And there's a chart showing that for the most part, people are either using products less or stopping their use of the products, switching to cheaper products, delaying a major purchase, reducing their savings. I'm happy that increased borrowing was down near the bottom. You know, that we're not just all adding things to credit cards. I feel like the one that's missing is just like complaining, do nothing about it, because it feels like most people are just complaining and doing nothing about it. As I see that like Europe is flocked with people this year, they're closing stuff down. I mean, everyone's traveling, everyone's going to restaurants, everyone's still using Instacart and all this stuff. So like, I'm not sure. I think that one should have been on there first, but I'm happy at least it's not going to increase borrowing. What are your thoughts?
Nothing. There's no, I'm doing nothing different.
You're doing nothing different.
But that's not even there.
No, well, I mean, this is for a lot of people, it is affecting them, right? I mean, it's not like everyone's being affected, but a lot of people are being affected.
Wow. Surveys always give you interesting results. Who do they ask? Was it a group of wealth management firms? Was it just U.S. citizens?
I don't know. I don't know.
Huh.
Moving on. One of the things that I think that people don't talk about enough is they're not getting it when it comes to this possible recession going out there. Way too many people still are keeping money on the sidelines, looking for that lump sum investment and putting it at the right time. I got to get in when there's a dip. I got to get in when there's a recession. I got to get in after the recession, whatever it may be. So Northwestern Mutual, boo, we don't like, at least put together a great chart. And this chart basically shows whether you have your money all in stocks, a blended 60-40 portfolio of stocks and bonds, or all bonds, what is your probability of outperforming a lump sum investment versus dollar cost averaging? And lump sum investing works, as you can see in the bottom line, 3/4 to 90% of the time better than doing a dollar cost averaging.
Wow.
And so a lot of people would say, I'm surprised by that because you get it at the wrong time and that's it. You messed up on that big investment. But the point is, though, that having your money in cash over, in this case, lump sum or dollar cost averaging was done over 10 years. You've got way too much money in cash with a market that tends to go up. And I want to read a line off the survey, which I loved, or off the study, which I loved. It says, dollar cost averaging small amounts tends to be a better strategy, than saving and accumulating cash and waiting for a good time to invest. Historical data shows that investors aren't very good at market timing. Dollar cost averaging ensures a small amount of cash that's coming in the door is immediately invested in markets to capture potential long-term upside. So if you need to dollar cost average, you do it because emotionally, maybe it's easier to do. But over time, have your money sitting cash for years and years and years, trying to wait for that right time is a recipe for disaster.
100%. The math is undeniable. Unfortunately, this is another good little chart. This is actually pretty more concise than what I've seen before, because I've seen papers that just kind of make the same point. What are the problems? There are two obvious problems. The first one is regret minimization, because we both know that people are they're not doing it because they're necessarily thinking they're going to get a higher return. They're not investing a lump sum because they're afraid of the market falling shortly thereafter. Make a big investment, it falls a ton. So the idea there is optimizing for regret minimization as opposed to highest expected return, because you're not a walking spreadsheet, so to speak, which you got to get, given a lot of our job is behavioral in nature. But you need to know what you're giving up in order to get that added peace of mind, right? It's just hard to do that.
When people ask us or clients say, I don't want to invest a lump sum right now, I want to do it little by little, I think what we've always told them, at least put together a plan. Once every month, once every 2 months, once every 3 months, something that takes it out of a finger to the wind. Here's where I'm going to put my money into the market, and have it on a scheduled, like a dollar cost averaging, a scheduled system. You take out the emotion.
State and date. You have to remove the emotion and make it systematic, 100%. So the second point I was going to make is dollar cost averaging. Everyone thinks they're super intelligent and like a freaking mathematician, investment savant when they say DCA, dollar cost averaging. DCA, dollar cost averaging, was born simply because of the 401k space and the defined contribution space, where you got a paycheck once a month, once every 2 weeks, whatever it was, and you deferred an amount of that into your 401k. If you had a 12 months worth of the contribution on January 1st, the recommendation for the DCA would have been put the whole thing in now.
Of course.
It wouldn't have been do a little bit paycheck by paycheck. Right. So the only reason DCA exists is because it was operationally necessary. That's just what it was, because you couldn't do all of it up front because you needed to buy groceries.
And it works because markets go up over time, and almost every year the markets are higher.
Yeah. But it wasn't DCA. It does regret minimization, and it operationally makes sense because of how a paycheck works. It was not there to solve for highest rate of return.
Well, but I think the point would be lump sum is best. But if you had to choose between dollar cost averaging or trying to time when to get in, dollar cost averaging at least better than trying to time that.
Yeah, sitting in cash is always the worst. I'll take you up on that. All right, so this plays right into it. Brett, are we in a new bear market? Excuse me, a new bull market or not?
Well, we crossed into one recently. We just hit the end of June with the highest point of the year.
Exactly. But who the hell cares? All these naming conventions are funny, right? The bull market call is 20% off the lows. We hit it. Everyone who was waiting and waiting for the next shoe to drop, you probably missed out because it's going to take a lot. So the next two charts I think I have here is simply returns off the lows. So the lows so far, October 12th last year, you see different markets from the S&P in purple, the small companies in that light brownish color, to international in green. So from 33% to 13% off the bottoms. That's a nice place to be. Has the dust settled since October of last year? Has everything been solved? Has the dollar been figured out? Has it no, it hasn't.
Some things have, right? We solved the debt ceiling. The banking crisis doesn't seem to have gotten any worse. Yeah. Inflation has come down a little bit. So it's not everything that we're worried about.
The dollar's not dead yet.
Huh?
The dollar's not dead yet.
Right. So some clouds have cleared, but are all of them cleared? No way.
Yeah. And they're just new ones to replace them. So anyways, is it a new bull market? Of course it is. Sam Rowe over at Ticker had a nice little line. He goes, I'm reminded of what Juliet said in William Shakespeare play, Romeo and Juliet. What's in a name? That which we call a rose by any other name would smell as sweet. So yes, BH, the returns since October of last year are just as sweet, whether you call it a new bull market or not.
And then lastly, I've got a headache listening to Shakespeare.
So come on. You love Billy Shakespeare? I can't read it. I don't get it. But let's look at what opportunity is still left. Because now what happens? All the people that were waiting for the next shoe to drop are like, wait a second, I can't invest now because we're almost back to all-time highs again. Right? So well, which direction do you go? But this next chart shows of those same markets, how far are they still off their all-time highs? S&P, oh, less than 5% off. Hello, that was quick. What's that pink one? That's emerging markets. What's the not so pretty light brownish thing just above that? Small companies in the US. So you still have valuation opportunities outside the US and small companies.
So you're not, let me be clear, you're not recommending everyone take all their money and put it in emerging
Who
markets.
said the
and
R
small
word?
companies.
Why did you say the R word? I didn't say the R word.
What R word?
Recommendation.
No, but I mean, that's where you're leading, right? I think the point is that everything is down, but it's not like you take your money out of S&P, which is almost back to normal, and put it back into emerging markets and small cap.
No, but people want to know where these things are on a relative basis. And this is what this shows you, right? Look, we build portfolios here all the time. That's what we get paid to do on top of many other things. And when we buy a portfolio of stocks, we're not just buying the S&P, we're buying all these things, right? So ultimately, when you invest $1, we hope that some portion of that dollar is not just being allocated only to the S&P, a portion of it gets allocated to different parts of the market where you can see not all parts of the market have recovered back to almost all-time highs.
I mean, people want to see recommendations at some point from you, Marcos. You got to put your mouth on something.
I'd get canceled. I get canceled.
No, because if you're wrong, well, I'll forget. But if you're right, we'll always remember.
No, Mina won't care. She'll cancel me anyway. Oh man. All right. Last two things I have: concentration risk. These are from our friends at DFA. Actually, only the first one is. Same old story. I like this one because it goes back a long time. The other charts I'd seen were not as long. 1930 to now, it charts the largest stock as a representation of the US market, the largest 5 and the largest 10. What do you notice there, Mr. Horowitz?
The largest 10 are always a big percentage of the S&P 500.
Yeah, and for across all three, it's generally pretty consistent. It's ebbed and flowed, and yes, has come down since the 1930s, which makes sense. There's more companies, a lot of things have changed. But is concentration something to be scared about? No, I don't think so. I think it seems pretty normal. Number two is stop comparing this to the tech bubble, because the second chart shows earnings contributions. What does the market care about the most, Brett, over time? Not over 12-month periods, but over 5 to 50-year periods. What does the market care about most? Earnings, exactly. So at the company level, Amazon, Meta, Alphabet, Nvidia are expected to be the largest contributors to earnings growth for the S&P for Q4 23. Amazon, Meta, and Nvidia are expected to report year-over-year earnings growth of more than 100% in Q4 this year. In addition, earnings per share for estimates for all companies are for the since the fourth quarter of last year are all up. If these four companies were taken out, their earnings were removed from the S&P, earnings would fall to 4.2% from 8.2%. I read all that simply to say, this isn't just people saying, I'm going to pay more for the same level of earnings, which would be also known as multiple expansion, right? Same amount of earnings, you just pay more for them. This is more earnings. They're making more money.
Well, I am surprised that all the mergers have not led like the top stocks to be bigger and bigger, right? You think over time, it seems like every day there's a merger happening where companies getting bigger and bigger, but it's obviously not showing up in that first chart you show, which I would be surprised. I thought, man, we've done a horrible job at keeping these mergers from happening, but obviously it hasn't happened in terms of their weighting on the market.
Exactly. And that's let capitalism do its thing. And the reality is, and this is kind of to that point, it's also silly to think that Amazon or Apple or Google are just one business when they're really an amalgamation of tens or 20 or 50 businesses that have billions of dollars of revenue.
Well, so last chart here while we wrap up, switching gears. Unfortunately, you are on the wrong side of this chart. It's actually not really a chart; it's just a stat. But
I was going to call shenanigans on this chart, but it's okay.
So a new Fidelity study, I think a year or so out, said that over the last 10 years, on average, women outperformed their male counterparts by 0.4% per year. Doesn't sound like a lot, but when you add it up over many years, it ends up being a big amount. The main reason is because men apparently are overconfident, or not us. I mean, I guess this is other men.
No, definitely not me. Yeah.
Overconfident, and we're overactive in our trading. So the study said that on average, trading reduces men's returns by 2.65% per year. Women's trades end up netting them 1.72% less per year. And the result is that on average, everybody loses money by trading. In other words, what you sell does better than what you bought. But because we're overconfident, we do a lot worse.
Wow. So they're better by being less bad.
Yeah. They do
That's
less,
fine, dude.
and they know that they can't predict the future. And that's why they do better.
I'm glad you brought this up because I've been meaning to talk to you about your overconfidence. This is why Schaefer manages all of our money. Okay. She has all control, all the buttons.
Well, we need more women than in the investment committee.
Got it. And I'm kidding. I don't have the button, and neither does she. Eventing Katz does all the stuff for us, and it's wonderful not to have to worry about it.
Well, let's be humble and let's trade less, and we'll do better.
To humility, my friend. Happy 4th of July, listener. Happy 4th of July, Brett Horowitz. I love you.
Enjoy your hamburgers and hot dogs.
Sauerkraut mustard.